Picture this. It's 2006. The economy is booming. House prices have been climbing for a decade straight. Your neighbor just bought a $400,000 home with no down payment, no proof of income, and a credit score that should have disqualified him 3 times over. The bank didn't just approve him, they called him. Your coworker just flipped her second property in 8 months and made $60,000. Everyone around you is getting rich off real estate, and you're starting to wonder if you're the only one missing out. And then 3 years later, gone. All of it. The biggest financial collapse since the Great Depression wiped out $13 trillion in American household wealth. Millions of people lost their homes, their jobs, their retirement savings, in some cases, everything they had ever built. Here's the part that haunts me. Every single warning sign was visible, every single one, and almost nobody listened. If you're someone who wants to understand how financial disasters actually happen so you never get caught in one, make sure to hit the subscribe button and give this video a thumbs up if it helps you out. Alright, let's go back to 2008. To understand what went wrong, you have to understand what the years leading up to 2008 actually looked like from the inside. After the dot-com crash in 2001, and the economic shock of 9/11, the Federal Reserve slashed interest rates to historic lows to stimulate the economy. Borrowing money became incredibly cheap, and when borrowing is cheap, people borrow a lot. Banks saw an opportunity. If they could give out more mortgages, they could make more money. But here's the thing, they didn't want to hold those mortgages on their own books. Instead, they packaged them together into products called mortgage-backed securities and sold them to investors around the world. Wall Street firms were buying and selling these packages as fast as they could be created. And this is where it gets really interesting, because suddenly the bank giving you the mortgage had almost no reason to care whether you could actually pay it back. They weren't going to hold the loan, they were going to sell it. So the standards, the checks, the verification, the basic, can this person actually afford this? Questions quietly disappeared. Here's what most people don't realize. At the peak of the housing bubble in 2005 and 2006, roughly 40% of all mortgages issued were subprime, given to borrowers with poor credit, little income verification, or both. Some loans required literally zero documentation. They were called ninja loans. No income, no job, no assets, approved. Now here's what should have been obvious and wasn't. Warning sign 1. Housing prices defied all logic. Between 1997 and 2006, U.S. home prices rose by over 120% nationally. That is not normal. Historically, home prices track roughly with inflation, around 1 to 2% a year in real terms. A 120% run-up in under a decade wasn't a market, it was a mania. Economist Robert Shiller, who would later win the Nobel Prize, was publicly saying as early as 2003 that home prices were dangerously overvalued. Almost nobody on Wall Street listened. Warning sign 2. Debt was everywhere and growing fast. By 2007, American household debt had reached 130% of disposable income. People weren't just buying homes they couldn't afford. They were pulling equity out of those homes to fund their lifestyles. New cars, vacations, home renovations. The house had become an ATM, and the entire machine only worked as long as prices kept going up. Warning sign 3. Nobody understood what they were buying. The mortgage-backed securities being sold around the world were so complex that even the people selling them didn't fully understand the risk inside them. Rating agencies, the companies paid to assess how safe these investments were, gave many of them AAA ratings, the highest possible. Some of those packages were stuffed full of ninja loans. The system had completely lost touch with the underlying reality. Warning sign 4. The market started cracking in 2007, a full year before the collapse. In early 2007, subprime mortgage lenders started failing. New Century Financial, one of the largest subprime lenders in the country, went bankrupt in April 2007. Bear Stearns had 2 hedge funds collapse in June 2007 because of mortgage exposure. These were loud, visible warnings, and the stock market shrugged. The Dow Jones hit an all-time high in October 2007, just 12 months before the worst of the crash. By 2008, the cracks had become craters. Home prices started falling, and when prices fall, everything in the system that depended on them rising starts to break at once. Homeowners who had taken out loans larger than their homes were now worth simply stopped paying. Default rates spiked. The mortgage-backed securities that investors around the world were holding started losing value fast. In March 2008, Bear Stearns, a 85-year-old investment bank, collapsed over a single weekend and had to be rescued. In September 2008, Lehman Lehman Brothers filed for the largest bankruptcy in American history. The same week, the insurance giant AIG required a government bailout of $85 billion to prevent a total collapse of the global financial system. The stock market fell 57% from peak to bottom. Unemployment hit 10%. Over 3.8 million Americans lost their homes to foreclosure between 2007 and 2010. And ordinary people who had done nothing wrong, who weren't speculating, who weren't flipping properties, lost jobs, retirement savings, and financial security they had spent decades building. The system had failed them, but the warning signs had been there the whole time. Here's the thing about the 2008 crash. It wasn't a random earthquake. It was a slow-moving disaster that anyone paying attention could see building. And that means there are real, practical lessons that apply directly to your financial life today. Lesson 1. When everyone around you is getting rich fast, slow down. The single most dangerous phrase in personal finance is, "This time, it's different." It never is. When an asset class, whether it's housing, crypto, tech stocks, or anything else, rises so fast that it defies all historical logic, that is a warning sign, not an invitation. The 2008 crash didn't happen because people were stupid. It happened because they let the fear of missing out override their common sense. Lesson 2. Understand what you own. Millions of homeowners in 2008 didn't fully understand the terms of their own mortgages. Adjustable rates that would reset, balloon payments, prepayment penalties. Millions of investors didn't understand what was inside the financial products they were buying. If you cannot explain in simple terms why you own something and what the risk is, you should not own it. Lesson 3. Debt is leverage, and leverage cuts both ways. Debt amplifies gains when things go well, and amplifies losses when they don't. The people who lost the most in 2008 weren't the ones who had less money. They were the ones who had taken on the most debt relative to their assets. A conservative balance sheet, low debt, real savings, diversified assets, is boring until the moment it saves everything. Lesson 4. Your emergency fund is not optional. The people who survived 2008 with their financial lives intact were the ones who had cash reserves. When the job losses came, and they came fast, the people with 6 months of expenses saved had time. Time to find another job. Time to wait out the market. Time to make rational decisions instead of desperate ones. The people without that cushion were forced to sell investments at the worst possible moment, locking in catastrophic losses. Look, the 2008 financial crisis feels like history, but the forces that created it, cheap debt, speculative mania, people taking on more risk than they understood, those forces never went away. They just changed shape. The warning signs of 2008 were visible to anyone willing to look. The lesson isn't to live in fear of the next crash. The lesson is to build a financial life that can survive one: low debt, real savings, investments you understand, a cushion that buys you time when things go wrong. The people who came through 2008 intact didn't get lucky. They had just built the right foundation before the storm arrived. Build yours now, before you need it. If this video gave you a clearer picture of what actually happened in 2008 and why it matters to your money today, hit the like button. It genuinely helps this channel reach more people. Subscribe for more content like this, and drop in the comments, what do you think the next big financial warning sign looks like? I read every single one. See you in the next one.